joining us for session 2 is Mr. Varun Goel, who is the head of equity and alternative assets at Nippon India. So he is going to be speaking to us on the topic when fear trumps rationality. Mr. Varun has more than a decade of experience in fund management focused on Indian equities. He has been successful in identifying themes and stocks that have provided multiplier returns. Earlier, he was a vice president and fund manager with Motilal Oswal Asset Management Company. He pursued his MBA Finance and Marketing from IIM Lucknow and BTech Mechanical Engineering from IIT Delhi. So joining us this morning, Mr. Varun, a very warm welcome to you. A quick note
Good
to
morning
all
to
the
everybody. Thank you so much for having me.
It's our absolute pleasure, sir. So before I let Mr. Varun take over the session, a quick information to all of the participants. We will be sharing the presentations from our end as well. So for any further assistance, you can reach out to us. So on that note, I'd like to hand over the session to Mr. Varun. Thank you so much for joining us once again.
Thank you so much. Good morning to everybody, all the participants in this wonderful 2-day conference. Let me start by talking about something which is very, very relevant, something which is, I think, touched the life of all of market participants this year, which is the extreme volatility that we have seen. So we started the year with 12,000, things looking great, people hoping for a cyclical recovery along the way. Then what happens? All of a sudden, we are seeing markets crashing to 7,500 on Nifty. And then, when people thought this is the end of the world and they were forecast to 4,000, 5,000 on Nifty, suddenly, we are seeing markets going back to 11,000, then 12,000. And today we are at a lifetime high of 13,000, right? So which has been a phenomenal journey. And I think all of us have been zapped by this. All of us have been, impacted by this extreme volatility. So I think this is something which affects all of us. This is something which bothers all of us, and we thought it was a good idea to understand how this journey has played out in the last few years. I think we'll just try and get the slideshow started. Let me talk about, I think, in the first slide of this presentation, we have put the information about 3 different big corrections that at least we have seen in the last 20 years. The first one was the dot-com burst in 2000, in early 2000. Then we saw the Lehman Brothers crisis in 2007 and 8, and then finally we saw the Corona crisis, in March 2020. So I think the funny thing about all of these 3 massive corrections is that we have seen big, massive corrections, and then we have seen sharp moves up. So the funny thing about all of these corrections is that if you see from the top, the drop is more like 40, 50, 60%. And when things like this happen, there is a lot of fear, and it actually trumps all kind of rationality. It trumps all kind of analysis. I personally, could be accused of being guilty of this, that in extreme pessimism, all your mathematical analysis that now the PE is very low, it's a good time to invest. So while you do that, you still don't invest enough, or what rationality normally demands, right? So let us go to the next slide. We are going to see how after the COVID crisis, how the PE ratios were looking like, and how it was an extremely positive and a great opportunity for market participants to invest. So if you look at the next slide, which is slide number 3, if you look at the PE ratios, if you see the last 15-year average PE ratios of the market, you will see that the markets had. So in this slide, if you see, we are seeing the PE ratios are actually fallen much below the 15-year average. And if you go by the mathematical analysis, it was a great time to put a lot of money to work in the equity markets. Even if you were invested in equity, you could have increased allocation. If not, you could have realigned your portfolios to make sure you invested in the right kind of portfolios, right kind of funds, right kind of companies. But when this thing, or when these events always happen, there is a lot of fear. There is always a lot of panic, and you always hear lower levels. So when 8,000 happens, you're looking at 7,000. When 7,500 happens, I heard levels of 4,000, 5,000, and so on and so forth. So what happens in these times? Wherever the momentum is, people tend to look at that and forget that there is a certain fundamental value to each company. There is a fundamental absolute value to each of the businesses. At the end of the day, these are not just prices. These are actually a share in the underlying businesses. As you can see from this slide, which is the fourth slide, 90% plus times whenever PE ratio falls below 15 times on a forward basis, you would see 90% plus times you would get absolute positive return in the next 1 year, right? Which is an absolutely phenomenal statistic. So what history tells you, what probability tells you, is that whenever markets fall to such low levels, you have to automatically start buying in the market. But this rarely happens. A lot of people stay away. In fact, this year in April, May, and June, when markets went from 7.5 to 9 and 10,000, we saw a lot of selling because people thought this is just a dead cat bounce and we're going to go back to the lower levels, right? So this is something which keeps happening, which keeps all of us afraid to go out and invest. And look what has happened. While we knew that whenever market P falls to such low levels, 90% plus times, we're going to end up with very, very handsome absolute positive returns in the next financial year. We still held back. I think most of us held back, to the exception of a few very brave people. And we saw that markets bounced back very, very strongly, right? So all of us have kind of grown up with the saying that I think this is something that all market participants have heard, that be fearful when others are greedy and be greedy when others are fearful, right? But not many of us can claim that we have actually followed this, right? So what happens is, while this looks great during good times, we know, yes, we prepare that next time the market correction happens, I'm going to put a large part of my investments into equity and we are going to make the maximum out of it. But when the actual event happens, right, the way we are psychologically tuned, the way our psychological upbringing is, there is a lot of fear. There is also a media frenzy. There is a lot of articles, news, which comes around, which tells us things are going to get a lot worse. And we combine it with our own fear and we forget the advice that, of course, wiser people have given us. At the same time, we also forget our own decisions that we made, during good times, that next time there is a correction happen, we will go out and invest. So what we are saying is that it is difficult to follow this advice. Second most important thing is that, I think psychologically, if you see, what Morgan Housel told us in his new book, is that, the way we are wired is that while when the crisis happens, we have our learnings from it, right? So we all learn now. 7-8 months down the line, we can learn that yes, it was a great time to invest, but time heals everything. Maybe this thing that we're talking about today, 4, 5, 6, 10 years down the line, we may forget this, and the next time the big correction happens, we might forget that we decided to invest during times of correction and then move on in life, right? So there is a recency bias. As time passes, we tend to forget the most important learnings and lessons that all of us have had during the painful periods, right? So this is something which is extremely important. This is something which is extremely relevant to all of us. So every step down, plants the seeds for the next ride up. That's what, another of quotes of Morgan Housel. What we are saying is, whenever this thing happens, whenever we lose money, whenever our portfolios are down 10, 20, 30%, we should also know that it has also laid the foundation for the next journey up. And we should never forget that point, because if we forget that point, we are going to be unable to take advantage of it, right? For a lot of people in the market, this is the first big correction that has happened. So it's a first time experience. But for a lot of us, we have been there for the last 10, 15, 20 years, and this is probably the second or the third correction. And so every time, we go through this, we need to learn from this and keep the learnings with us so that the next time the correction happens, we are able to take advantage. So I think, so in nutshell, what we are really saying is, when there is a big correction, when panic happens, when there is a lot of fear, keep calm, think through rationally. It is possible that you start investing a little early than what you initially thought, but it is important to take the rational action. And the one best way to do it, I think, if we go to the next slide, we will see that now the alternative asset streams, be it our PMS or our AIFs, they all come with drawdown construct. So I can tell you, in our AIF, we introduced first in the time of the industry, we have introduced a SIP plan. So what you can do is you can now put 30% of the money upfront, and the remaining can be either be paid over a period of 6 to 9 months through two more drawdowns of, let's say, around 30-35% each. Alternatively, what you can do is you can pay only 25% or 50% upfront, and the remaining can be paid over a period of 12 to 18 months through a systematic investment plan, just like you do in mutual funds. So what happens in this kind of process is you're able to take advantage of the volatility. You get your foot in the door, right? It is important to get your foot in the door, because when the market runs up, then you don't know what is the best thing to do. Similarly, in the PMSs, as you're now aware, that most PMSs, including ours, give you an option of investing through a systematic investment plan, and they will give you the comfort of doing gradual investments, and you know taking your time with putting your money to work. What this will ensure is that even when things are difficult, even when there is a fear, you have something invested, and gradually you can increase your exposure. And also, the most important thing, if we go to the next slide, we will see that we have also learned that it is important to be invested in the right stocks. So that is why we keep emphasizing the point that please be invested in the quality stocks. Don't chase momentum. Don't buy things. So I think this is very, very important in the current context. Last month of November, we have seen all kind of stocks flying across the shelves. We've seen, the laggards, some of the companies with poor fundamentals also doing very well. Not to take away the fact that they have given good returns, but please keep in mind that whenever the tide turns, some of the poor quality companies will be the first one to correct. So our emphasis has always been that buy quality companies. So our framework, which is the must five quality framework, we ensure that you're investing in companies with good growth. We're investing in companies with no promoter pledge, as we've seen a lot of these things blowing up in the last 3-4 years. We've also seen a lot of corporate banks and NBFCs blow up because of poor corporate governance. And these are the companies which are the worst impacted whenever a crisis happens. And the important thing is, even if you buy these companies, so let's say there is an NBFC which was 100 rupees before the crisis. If you buy it at 10 rupees after the crisis and you believe that the price will go up, chances are that it will not. Because if the business is permanently destroyed, if the business mode and competitive advantage is permanently destroyed during the crisis, there is no way the business will come back. And therefore, it is important that every time a crisis happens, we are looking to invest good quality companies, which are available at very, very cheap prices. For instance, without taking any names, that one of the India's best managed banks and NBFCs fell 40-50% during the corona crisis, and that was a great opportunity for most of us to go out and invest in these stocks. So what we are really saying is, don't waste a good crisis. As the old saying goes, keep the lessons with you. If needed, please write it down in a diary or someplace in your phones, so that whenever the next opportunity comes, and it will come in markets, you always get the opportunity. So don't let fear trump your rationality and take advantage of the crisis. That's the message from my side. Thank you so much for the time.